No tax on tips and overtime. What really changes in 2025? Starting in 2025, you may have heard this phrase everywhere: no tax on tips and overtime. Sounds great, but what does it actually mean for employees and employers? First, this is not a total tax exemption. These are new federal income tax deductions, not free money. You will still pay Social Security and Medicare taxes and usually state income tax on tips and overtime. If you work in a job that traditionally earns tips, like restaurants, salons, or delivery, you may qualify for the qualified tips deduction. You can deduct up to $25,000 per year from your federal taxable income, depending on your income level. But only voluntary tips count, not automatic service charges. When it comes to overtime, there are important differences, especially for California workers. Under federal law, only overtime required by the Fair Labor Standards Act qualifies for the deduction. That usually means working more than 40 hours in a single week. But California has its own rule. In California, overtime kicks in after 8 hours in a single day. Here's the conflict. If you work 10 hours in one day, but only 38 hours for the entire week, you still get overtime pay under California law. But that overtime does not qualify for the federal overtime deduction because it wasn't required under the Fair Labor Standards Act. So yes, you get paid overtime, but federally, that extra pay is not deductible. Now here's the part that's confusing a lot of people. For 2025 only, employers are not required to report tips and overtime separately on W-2s. That's not an error, it's a transition rule from the IRS. Employees may need to use pay stubs, tip logs, or personal records when filing their 2025 tax return. If you're an employer, don't panic. You can continue using your current payroll setup for 2025. Starting in 2026, the IRS expects separate reporting, but 2025 gets a free pass. Most people won't see extra money in their paycheck right away. Instead, the benefit usually shows up when you file your 2025 tax return in early 2026, as a lower tax bill or a bigger refund. So yes, the deductions are real, but the rules matter. If you're an employee, keep good records. If you're an employer, treat 2025 as your prep year.